The economic policies so far have been a huge disappointment. I guess we could debate as to what some of the successes have been in some areas of foreign policy, although some of that still remains to be seen. The border seems more secure. Immigration, of course, the Doge file had its impediments, but I don't think anybody was ever going to argue about Washington eradicating fraud and abuse and waste. Perhaps we could talk about how it was all executed. And same with the trade and tariff file, about how it's all being executed in such a throw spaghetti against the wall and see what sticks. So it's created this chaotic environment for the business sector in terms of your question. We all know that starting in 1987, Donald Trump, the real estate mogul back then, was talking voraciously about how America was being ripped off. This is all the way back to the mid-1980s. So the word tariff was always his favorite word. America, despite its economic supremacy and American exceptionalism, it didn't matter. America, in Donald Trump's views, and of course a lot of his supporters, that the U.S. was always getting ripped off by its trading partners. So this was part and parcel of Trump 1.0. Trump 1.0, though, the tariffs came, but were really targeted to some countries. They were targeted to some particular items, whether it was solar panels or washing machines or refrigerators. The big fight with China back then, was over soybeans, if you remember. And I think that a lot of us thought that, okay, well, Trump 2.0, of course, tariff and trade is going to be back on there, but to what extent? Because when you take a look at the polls going into the November election, what was first and foremost on Americans' minds were not trade and tariffs. They were the cost of living, immigration and the border, healthcare, and education. When you're taking a look at the list of items top of mind for the voter, tariffs and trade were right near the bottom. So the fact that the administration has made this their top economic policy, what happened to the deregulation? You hardly see any of it. What happened to drill baby drill? Or even the fiscal side, like saving the economy from falling off the fiscal cliff by the end of the year. If those 2017 tax revisions manage to sunset, we're going to have a really horrible recession, not just this year, but next year. And I think that's what people were thinking he was going to spend his time on. But the president has just gone full bore on this tariff and trade situation and has made it the centerpiece right now of his economic strategy. I'm surprised that he has gone all in on this strategy right now. And I think this will put at risk his fiscal policy and maybe put at risk next year's midterm elections. I'm surprised at the timing. I would have made the pro-growth aspect of his policy first. I would have made fiscal policy first. I would have put ensuring that all the 2017 tax revisions get extended first and foremost. I would have gone much heavier on the deregulation file. I would have gone much heavier on the energy file. And you see, this is why he was successful in his first term. Now, he didn't win his second term in 2020, but something called COVID got in the way, and Joe Biden managed to win the election by campaigning in his basement. But up until COVID, the economic record of Trump 1.0 was actually pretty good. But what did he focus on first? He focused on tax relief, and he focused on deregulation, and then it was later on, call it mostly in 2019, where he focused on trade and tariffs. And again, they were select. They were not broadly based like they are right now. So he did all the pro-growth stuff first, and there's no doubt that the tariffs and the trade frictions of 2019 was an impediment to growth. We did have, in the second half of 2019, we did have a capital spending recession. We actually had an industrial sector recession. That's why the Fed was cutting rates. Remember, the Fed went into 2019 pledging to hike rates twice. They cut rates 3 times because the economy went squishy soft in the second half of the year, but you see the consumer hung it together because it was still feeding off the previous tax cuts, which were significant. This time around, he's doing everything backwards, and he's starting off with the anti-economic growth agenda. And frankly, I don't know who he's listening to. Maybe he feels that he's got to get this done in his first 2 years, or it won't get done at all. But then again, none of this is coming through legislation. President Trump is operating almost exclusively on this issue through executive order and a loophole on national security from an arcane trade law that was passed in 1962 during the Cold War. So I would say that I'm surprised at the timing. April the 2nd, Liberation Day. Yeah, I called it liberation. Liberate us from insanity. I mean, what was that? I mean, first, the U.S. is going to take its average tariff rate from 2.5% to 10%. But then he introduces reciprocal. And April the 2nd was an actual disaster because all those different numbers, 30% extra tariff rate to this country, 40% to this one, 50% to this one. Each number was different. Why? Because those numbers were quotients. They were basically the trade surplus that country X had against the United States divided by those countries' exports to the United States. The trade surplus divided by exports was the reciprocal tariff. So what Donald Trump was telling us on April the 2nd, when you looked at the hidden message, and maybe it's not so hidden, was his desire. These numbers reflected a desire and aim to obliterate all bilateral surpluses that other countries have with the United States. And of course, then we had the market reaction. The president's telling us, and Lutnick is telling us, and Besson's telling us that we're not looking at Wall Street, we're not looking at the stock market. But then they tell us, well, we're looking at the bond market. But they were looking at the markets in general because we were just within a couple of days of a true freeze up. We're talking about a potential repeat of 08 and 09. Different reasons, but the credit markets in particular were starting to freeze up. There was no investment grade issuance, no high yield bond issuance. Everything just froze up. The stock market was in free fall. The most economic sensitive sectors of the stock market were down 25 to 30%. So you can say, well, I'm not looking at the stock market, but it's like saying I'm not looking at the economy because the stock market was giving you a certain verdict of what this is all going to mean for the economy. So then everything that's happened since, and you mentioned that. So then, it's just like with Canada and Mexico, we're going to have these 25% tariffs, then we're going to have carve-outs, and we're going to have a reprieve, and then we're going to have these reciprocal tariffs, then we're going to have a reprieve, and then we're going to do trade deals. And you just don't know what to believe because there was a span there over a 2-week period where there was 18 different announcements coming out of the White House in terms of changes to what was already previously announced. So as an investor or as a business person, how do you plan in this environment of heightened uncertainty? Now, people will say, well, life is uncertain. Things are always uncertain. Yeah, I realize that. But, there are measures of economic uncertainty that go back decades. And you can model out economic uncertainty because we're talking here about a 5 standard deviation event. If you're taking a look at the measures of uncertainty, it looks like a dot-com stock in 1999. It has just gone vertical up. We just got the Fed's beige book last week. The word uncertainty showed up in a 50-page document about 100 times. And we never saw anything like this in Trump 1.0. The first economist that modeled uncertainty was John Maynard Keynes. Now, how do you model uncertainty? It's behavioral. But everything about economics, which is a social science, is about behavior. Spending behavior, investing behavior. And it's no different really than, I think the best analogy anybody gave was Jay Powell, who in December talked about, well, what is it like for a central banker in this chaotic environment? Is akin to being in a dark room with furniture. And what do? You stand still, you don't move so you don't trip up. You extend that analogy to the economy. What do you do in a period of high and rising uncertainty? Is you freeze up. Businesses freeze their CapEx plans, which you're seeing in all the data. Of course, the Fed's talking about the soft survey data, and they're waiting for it to show up in the hard data. The problem for the Fed is that when it shows up in the hard data, it's too late, we're in a recession, and they'll be scrambling, just as they did in the second half of 2019. But I think they'll be scrambling a lot harder this time around. Businesses freeze up CapEx. There's not a business that's going to be committing long duration capital in an environment where they don't have any policy clarity whatsoever. So businesses focus on their balance sheets, they focus on liquidity, and that comes at the expense of capital spending, which feeds directly into GDP. What do households do in a period of high and rising uncertainty? Now, I cannot believe all the people just going nuts over the latest retail sales number. You're seeing a massive increase in retail sales on goods ahead of the tariffs because people know that those prices are going to be going up. So we're front running all the expenditures. That's going to create an enormous vacuum in the spending data in the second half of the year. But what is the normal reaction when you model this out in terms of the household sector? Not much different than the business sector. You freeze up. You don't spend. You focus on raising your precautionary savings rate at the expense of discretionary spending. And that's what the macro theme is going to be from here until we get some semblance of clarity beyond just telling us, what deals are being negotiated right now. So you're going to get a freeze up in household spending, in capex, in hiring intentions, and I think to some extent the damage has already been done. So that's what uncertainty does. We modeled this out in classic John Maynard Keynes fashion and found that just the uncertainty alone, not even including the direct impact of the negative trade action, because we don't know what that's ultimately going to look like, especially with China, which is the elephant in the room. Just the uncertainty alone and the impact that has on the savings spending relationship would be enough to drag real GDP growth down by between 1 and 2 percentage points from the counterfactual baseline growth, which is right now running just over 2%. And that's how just the uncertainty alone causes virtual economic stagnation. You might say, well, that's not the colloquial classic back-to-back quarters of negative real GDP. That much is true. But when you have flat growth and ongoing increases in the labor force, that drives the unemployment rate higher. That creates more excess slack in the labor market. That ultimately leads to weaker nominal wages. And that then leads to lower consumer spending. And that's where things get really complicated. There's all these second order impacts. I'm glad you led off with the indirect impacts of the uncertainty, because a lot of people don't recognize just how damaging that is to the economy on its own, irrespective of what we're going to get the real damage if these tariffs ultimately do go through as is.